Welcome back to Focus Fridays, the series where we open up the playbook on real estate investing, all the way from foundational concepts to sophisticated strategies that investors use to grow wealth with confidence. I'm Jared Shum, head of investor relations here at Focus Capital, and I'm joined again by our VP of Investments, Chad Olson. Chad, last episode we went into loan types, agency, bridge, CMBS, debt funds. Today we want to go into the interest side of things. So not just interest rates, but the specific structural feature of interest-only periods. On the surface, it sounds pretty straightforward. You're paying interest, not principal, but the implications for cash flow, returns, risk are a little bit more nuanced than most investors might realize. So I wanted to take some time to walk through that. Want to start with the mechanics. What does it actually mean for a loan to have an interest-only period, and how does that work mechanically?
All you're doing is the bank or lending institution is acknowledging the fact that they're willing to forego any kind of amortization and principal payment down during a defined period of time. Generally, the real way or reason it's structured is to give the property and the operator time to execute some sort of business plan and limit the amount of cash that has to leave during that time. And because all you're saying is like, okay, if there's a 5% rate on something, you're going to pay 5% of the outstanding loan amount every, year for that period of time. And whereas with fully amortized loan, you're going to have interest that's paying along with your principal payment. It's going to be heavy front loaded on the interest in the beginning. The whole thing that's very similar to your personal mortgage. But this transcends into a variety of different lending products that will give you the full term IO. And so all it's doing is reducing, like I said, the outbound cash and increasing your cash flow at the bottom of the line to be able to distribute back to yourself or investors.
Okay, so a $6 million loan at 6.5% would mean interest-only monthly payment is $32.5, so $32,500. Once it converts into a 30-year amortizing schedule, the monthly payment jumps to $37,900, which is an increase of about $5,400 a month. So, or roughly $65,000 per year. That's real money coming out of cash flow, and operators who don't account for that accurately are setting investors up for a distribution reduction they didn't expect. How do we at Focus Capital kind of mitigate that? How do we plan that into our distribution schedule when it comes to when a loan amortizes?
It's all captured in the model. So when you're looking at our kind of pro forma breakdown, you can find it. It's usually shown in our slides and stuff like that, especially on the investor distributions, where you'll see kind of cash flow increasing for a year, 2, 3 years, depending on the interest-only period. And then the following year that interest-only period takes off, it'll come back down slightly, usually in the amount of the amortization kicking in and the principal pay down starting, and then start to come back up as we increase the operations of the property.
When it comes to kind of the deal math, does the interest-only period change the exit value or total equity multiples significantly or anything like that?
No, it just increases cash flow. It actually has, interest-only is not a free lunch. So just like a buy down isn't either and stuff like that. If you're doing interest-only or taking a buy down, you really want to exercise the entirety of the loan because you want to exercise the entirety of the loan because you're going to have that full principal amount at the time, which then yield maintenance will come into play depending on where rates are. There's a lot of factors that go into it, but it's most advantageous if you play out that whole loan.
So quick maths on there, and let's talk about that same loan that I had talked about in my previous example. Is $6 million loan, 6.5 interest rate, 30-year amort, 5-year hold. With full amortization from day one, your annual debt service is $454,800. So that means that your year one cash flow, assuming an NOI of $700,000, would be about $245K and some change. So that cash on cash return is roughly 9.6% on $2.55 million in equity. But with 2 years of interest only, your annual debt service from year 1 to year 2 will be 390,000. Again, same with the same NOI, you're at 310K in cash flow year 1 through year 2, which is cash on cash of roughly 12.2%. So for people listening in, the step up goes up to that 454,800, but you're increasing that cash flow in the first 2 years, which helps with distributions, helps with part of the business plan, help aligning. And like you said, it doesn't change the exit value, it doesn't change the equity multiple, but it does shift cash flows forward in time, which helps boost IRR because of the time value of money. And the magnitude of IRR of improvement depends on an interest-only period length, the loan amount, and the hold period. If the deal doesn't exit before the interest-only period ends and the step-up in debt service coincides with a period of operational stress or market softness, the cash flow impact could be pretty heavy. How do we as operators model that step-up scenario when it comes to our stress testing?
You have the model and you have stress tests for the various scenarios of how they could play out, but that's going to be more of a leading into that year. So as we do every time, we're creating budgets every year, we're testing those budgets, we're trying to beat performance, we're fixing the things that are causing issues, all those kind of things. So if it's going to be year 3, going from year 2 to year 3, we're going to create a budget. We're going to fully know about amortization. We're going to know where the market is. And then depending on what's going on in that moment, we would either choose to pull back cash or do this or do that, inform investors, those kind of things. But as goes the model, you're just running different situations about, okay, if rent growth is down to 0% or 2%, and like what do returns look like and all those kind of things. And you just make sure that inside that band of possible outcomes, that the returns are still there to some degree if you're off performance and everything else like that. So.
Yeah. You talked about like there's no such thing as a free lunch. So I kind of want to address some of the downsides. Like are there risks that come with interest-only periods? What are the risks that come with interest-only periods?
I wouldn't say that there's risk in the interest-only period itself. It's just that do you get used to that cash flow and knowing that it's going to end or change pretty significantly. There's risk in the sense of like some people, again, it goes back to strategy as your defining thing in this. Some people would rather it be amortizing. They don't want the interest only because what you're doing is, yes, you're getting more cash flow in the front end, but you're not paying down any principal. Okay, so that delta between what you can sell it for and what's outstanding isn't growing during that period of time. And so sure, you're able to close cash, but you're not paying anything down. Some people, when they're thinking about buying a house or buying property and assets in that thing, they're paying down the loan amount over that course of time and they're building up equity inside of that asset, right? You're just delaying that for that time period. Especially with the way our loans are structured, it's a balloon payment. Outside of a HUD loan, every one of them is on a balloon. So it's going to balloon and you're going to have to, at the end of that loan term, you have to pay the entire outstanding balance. So if you're delaying that, then that number stays higher by the time that you go in there, instead of just having a fully amortizing loan at the beginning and then building your business plan off of that. So the risk in that is just the way you do strategy. Some people like to buy these assets and hold them for the long term, and they want to pay down the loan balance over time.
Is there any type of refinancing dependency when it comes to interest only? Because I feel like when we underwrite loans, and you can correct me if I'm wrong, and we underwrite the whole deal, the deal structured with IO or interest only often assume a refinance at a certain period of time or shortly after the IO period ends, which is fine when capital markets are cooperative. But what happens if what kind of pressure is created if the market isn't where we want?
Well, we do not underwrite deals at this point with a refinance in the model. So we just take that out of it. Is it a possibility and is it something we're going to try to execute on? Yeah, absolutely. But we do not base our returns off that premise, right? So we try to underwrite them for the 5-year hold period to make sure we hit all our numbers. And then if we fully execute the business plan and can do exactly that, we'll do exactly that. As long as it's accretive to the deal when we do the refinance and the capital event and everything else. So taking out that risk, because yeah, to your point, it's like if you're in a moment where the market suffered, rates are up or whatever else like that, that refinance situation could change pretty drastically. Even with that, when I do testing of the refinance situation, I'm usually not looking at it with interest only. I'm usually not looking at that on the DSCR sized off of that. I'm making it pretty conservative to see, okay, we can return 20 or 30% of capital. And I think we generally, if we're doing everything that we're supposed to be doing and execute the business plan that leads to us being able to hit a certain IRR metric at year 5, we should be able to refinance for a heck of a lot more proceeds out of it. But yeah, we just don't take that into account. Then it allows us the flexibility to take that risk off the table because it is there.
Yeah. Kind of wanted to shift to today's rate environment versus the past few years. You kind of touched on that in our last episode. Is there a difference in evaluating interest-only periods today versus during COVID / post-COVID?
It's more important because now the rates are so high that you got to be really cognizant of where deals are and the cap rates and the interest rates and the this and the that. And so those things really do eat into cash flow. And so I would say the interest onlys are more important to be able to generate something with all the aforementioned stuff.
Yeah, I think I kind of want to lean into what investors should specifically look for when evaluating interest only in a deal, what kind of questions they want to ask. The first top line question I feel like every investor should ask is what happens in the deal after the interest only period ends. How long is the interest only period is obviously another question. What other questions should investors ask when evaluating if they're going to invest in a syndication or not?
That's it. It's not a very complicated thing. It's just what is, once you know the interest rate, how long's the term and what's your plan when it ends? And it should be in the model, should be captured in the model. I think that would be a flag in of itself if you look at a model and it doesn't exist there in the same way that if there isn't prepayment or yield maintenance in a year earlier than whatever the loan amount is or loan term is, or in inverse, if you have a loan term for 3 years, but you're holding it for 5, it's like, okay, well, what are you doing these 2 years? Where's that? Like that needs to be in there. We, again, are just looking at it, hey, 5-year hold with no refinance. That's fine to do. We don't need to put that in there. And to that end, it's like, if you do, I can pay a higher price because I've increased my returns, which then decrease the back end and stuff like that. So that's what we're trying to avoid. But if there's timeline discrepancies, those are things to poke holes in and to ask deeper questions. Where is these different structural things? But for the interest only, it is just what's the term and what's your plan after it goes. And then from that, you could have more questions. But
one of the deals that we just finished raising for down in Bloomington has a 24-month interest-only period, but it is a 5-year hold. I know that you said that we don't underwrite to refinance, but it's something that's part of the business plan to look at one at the end of year 2, beginning of year 3. What kind of benefits does that have to the investor if we do refinance, and then how does it affect the deal if we don't refinance?
So if we do refinance, then it's got to be accretive. So the environment would be that we have a lower rate than what we're currently at on the banking side, which should happen as long as rates stay around the level that they're at right now, because we're basically right close to a 7, and most of the agency financing is in the 5s. So there would be a pretty considerable spread reduction there. We would continue on the interest-only train for now another 24 to 36 months. So there'd be increased cash flows from that outside of just the reduction in rate. And then we would return a significant amount of capital. And so that's what it is. Now, to execute 5 years, we would take on a potential of yield maintenance prepayment that we would have to assess in it, and that would go into the full holistic view of what we're planning on doing. But if you get a significant portion, 80, 90% of your capital returned or whatever, the investors might look at it and say, hey, I'm fine holding another 2 years, and get that cash flow and then sell it then. And then the returns will work its way out. And we'll stress test and look at all those different options and variabilities. And then to the other side of it, that if we don't refinance, then the returns are the returns. That's why we do it that way. So the stuff that you've seen in that deck and in our thing, as long as we execute that way with the sale, we will hit all the return metrics that we were looking to hit.
Perfect. Well, thanks so much for joining us. On our next episode, we'll kind of dip into interest rates instead of interest-only periods, and then how that affects real estate performance and potential returns out of any investments. So.
Sounds good.
Thanks for listening to this week's episode of Focus Fridays. We release a new episode every week, so be sure to join us next Friday and beyond. If you'd like to see our next investment opportunity before it goes public, you can join our investor list by filling out the form on our website, focusedcapital.com. If you have any inquiries about what we've covered on our podcast, general real estate investing questions, or suggestions for the show, we'd love to hear from you. Feel free to reach out to us anytime by emailing us at investors@focusedcapital.com. focusedcapital.com. Take care, and we'll see you next week.